Hey, it's time for the Financial Procast. Today is the 7702 Private Plan special episode. We'll discuss what it is, what it's not, and why it matters. That's today on the Financial Procast. The Financial Procast, Monday, October 28th, 2012, Episode 9. So private, we're not even sure how you found us. Web hosting for the Financial Procast is brought to you by The Insurance Pro Blog, where insurance gets demystified. Online at theinsuranceproblog.com. Hello, welcome. It is episode 9 of the Financial Procast. It's Monday, October 28th. This is our special 7702 Private Plan podcast. I'm Brandon Roberts.
And I'm Brantley Whitley.
You were waiting for me to do that, right? Like I just started talking and stopped, and you're like, do I say I'm Brantley Whitley?
Yeah, I don't know if I should actually introduce myself or not, but...
At this point, do we need to?
Yeah. Well, we might have new listeners. We can always hold out hope that there's actually new people that come and listen to our podcast.
If this is your first podcast, hello and welcome.
Yeah, we welcome you to the Financial Procast. And normally we do a show where we talk about various topics in the world of finance, I guess would be the right way to put it, huh? But today we are a one-trick pony.
A one-trick pony?
Yeah. 7702 private plans, or 7702 plan, whatever you want to call it.
A bad idea?
What's a bad idea? The 7702
you said whatever
plan?
you want to call it. I just said, first thing that popped into my head.
So, Brandon, shall we get into it?
We should.
All right.
We should start with your amazing explanation behind what a 7702 plan is.
My explanation of what a 7702 plan is.
I bombed at bad idea, so we'll see if you can go a little better.
A 7702 plan is not a plan at all. It's a life insurance policy.
Would have accepted unicorn or Santa Claus.
In the land of unicorns and candy mountains, there once was a 7702 plan.
No, actually, I have a little blurb here that tells me that it was IRS approved back in 2005.
Wow.
Yeah.
That's news to me.
I know. I thought it was around a lot longer than that.
I did too.
Maybe that's because the piece of legislation that they were referring to was around a lot longer than that. All right, now that we've spent like 2 minutes being extremely obscure and the new listeners are like, screw this.
Well, they're not listening anymore. So
The 7702 private plan is a great trick of sleight of hand where somebody sat down and said, we name things after legislation, so why not just reference the piece of IRC code that refers to the taxability of cash values in a life insurance plan and call it a plan? And so they referenced IRC 7702A, to be specific, which speaks to the taxability of cash values in a life insurance policy, and basically went out and started telling people that if they bought life insurance, they were participating in a 7702 private plan.
it's a brilliant marketing ploy is what it really boils down to.
Well, you're right. I mean, absolutely brilliant insofar as we think that Bernie Madoff was brilliant.
Right. Yeah. Deceptively brilliant. I guess I should have added that there. And, one of the things that we talked about, we had some discussions before we were, doing our show prep, is that some of the bigger, I guess I could call them big blue mutuals, really not only condone this sort of practice, but even allow their agents to brand 7702 plans as a, what's the right way to put it? To package them as a product.
As a sales tactic?
Yeah. I mean...
Lies. You can't possibly be telling the truth.
But I am. but I am telling the truth. And I've
I
seen.
think the appropriate response would be, "You're the one who sent me the email
I
with
was
the
about to
illustration
say.
that had that on it."
I mean, if I hadn't seen it, if I hadn't seen it with my own two eyes, I wouldn't believe it.
Yeah, so I'll speak to this since I'm the one who had it. Several years ago, I had somebody send me a proposal that they had been given by a relative who was an agent with Northwestern Mutual, and very clearly.
I mean, if you want to name names and everything.
Well, if you do the crime, so I was stunned to open up this illustration and look at it and see at the very top it said ACL blah 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 7702 plan.
Which ACL, for those of you who don't know, ACL is Adjustable Comp Life. That's the product name at Northwestern Mutual. But it doesn't say any. It just says ACL.
Right, and I sent this to you a few days ago and said, look at this, and I think you'll come to the same conclusion that I did when I looked at it. Not only is it stunning that that appears at the top of this thing, but absolutely nowhere explicitly in this illustration will you see any mention of the fact that this is life insurance.
Nowhere. I mean, I looked.
It's very obscurely referenced, but it's not. There's nothing in there that really says this is a life insurance proposal.
Right. It's very there's some very fine print down toward the bottom of the illustration that does mention Northwestern Mutual Life, which I thought was interesting. I mean, they don't even brand their name on this very much.
Mm-hmm.
It's just like one little part, and I think in one of the pages up, in some really obscure place it says life insurance or something. I don't know. Right? Am I right about that?
So we have. I mean. I think it's fair to say that the whole branding of the 7702 private plan was most likely a independent sort of game within maybe an IMO or a BGA somewhere that said, here's a good way to sell universal life or indexed universal life. Probably not variable universal life because most of the 7702 hoorah is about being market neutral. So I would assume that that's kind of where it came from. And if you look at some of the websites that heavily promote the idea of a 7702 private plan, the way that they explain the plan sounds very universal life insurance.
Right.
Not so much whole life insurance. So, again, that usually reeks independent market because they don't have tons of ready access to whole life insurance contracts.
Sure. Absolutely. Well, they certainly don't have ready access to high-performing, participating whole life insurance.
Yeah. So
although Northwestern Mutual has obviously latched on to this concept.
Exactly. And I have heard other career agents at NML and other companies reference IRC 7702 like it's a Roth alternative. And I'm not saying that that's necessarily a terrible way to do it as long as you do it under full disclosure, which is to say, if I sit in front of you and say, hey, I have a plan, and that plan works just like a Roth IRA, but it has an unlimited contribution to it. You in? That's a little sketchy. If instead we're
Brandon,
talking about...
Oh, by the way, this is life insurance.
Yeah. Well,
what? Can you speak up? What did you say this was?
This is life insurance.
And this is what really is sad to me. And I'm just going to throw my bit in, and then I'll shut up and let you talk some more.
Okay.
But I don't think there's any reason to apologize for life insurance.
Exactly.
Matter of fact, I mean, you and I believe that. I mean, it can stand alone and it can hold its own.
Mm-hmm.
It has it's like any other tool, any other financial tool. It has its pros and it has its cons. I mean, there's no doubt about it. But in our world, I mean, we always are very upfront about telling people, here's the good things and here's the things that you may want to consider.
Mm-hmm.
That you may view as negative, you may not. I mean, it just depends. But we never make an apology for what it is, and we're very upfront from day one about what it is.
Right.
I mean, it's life insurance, and this is how it works, and that's it. So it just bothers me when I see people who, it seems to me, are blatantly misrepresenting a great product, and sort of giving our industry, which already struggles with its reputation,
Mm-hmm.
you know, they're giving people another reason to doubt our integrity or our honesty, I guess.
Right. We don't want to be painted by the same brush and boxed into the same corner as the idiot who's out there pitching the 7702 private plan.
Yeah, exactly.
But to finish my point here, to sit down with somebody and say, why don't we look at life insurance, cash value life insurance that is designed appropriately as a low risk asset for your portfolio, and here's why you would do that, or here's the analog that we can draw to how it works to sort of give you a better idea. That's fine. I don't understand the people who try to pitch it as a plan, but then not talk about the fact that it's life insurance. I mean, you have to explain that it's life insurance eventually. Otherwise, you got to explain why it is that the paramed exam is calling them up. And a pension with a free health checkup has been a big no-no for a very long time. Unless, of course, you're out there selling something like a guaranteed issue whole life or UL policy to somebody under the auspices that it's a 7702 plan, at which point in time you deserve to watch your children die slow, painful cancer deaths or something like that, because that's just evil.
Yeah. Yeah, it really is. I mean, I don't know what
to be clear, and I really want to be clear, because you and I both know that we have received feedback on this very topic. We've been very negative about the idea of using the sales tactic of a 7702 plan, and that's really the best way to describe it. The 7702 plan is nothing more than a sales tactic. We don't like it, but that doesn't mean that we don't like the use of cash value life insurance as a savings plan.
Quite the opposite.
Exactly. We just believe in being upfront and honest when we want to present this idea, because we believe, as you already stated, it stands very well on its own merits.
Yeah, absolutely. And that's, I know we've gotten some feedback directly to blog posts that were written by you around 7702 plans, and people sort of misunderstanding, or I guess misunderstanding and thinking that we're throwing the baby out with the bathwater, so to speak.
Mm-hmm.
And that's not true. The baby being life insurance, the bathwater being 7702 plans. We would very much like to dump out anyone talking about 7702 plans, but we very much
get me the strainer.
Exactly. We very much, like the use of cash value life insurance, whether that be, index universal life, participating whole life, whatever.
I have
as
a
a
quote.
vehicle.
I have a quote here from an article that appeared on CBSNews.com back in 2010. They were doing a lot of coverage on 401ks, and I don't want to get into the comparing things at the moment, but they were doing a lot of specials on 401k plans and questioning whether or not they should be the de facto default retirement plan. And in the comments section, there's a person who came along, saw this, and saw an opportunity to pitch 7702 private plans. And I'll read for you the comment, because the comment really sets the stage for the sort of sketchiness that we observe and that we feel when it comes to pitching this sales tactic. In response to this article and the conversation about how 401k plans maybe don't work as well as we thought they did, Stephen Duvall is the name here, states, "This is something that independent 7702 private plan representatives have been preaching for a long time. There is just way too much control of your retirement with unregulated and greedy people with a 401k plan. But things are changing. Every month, thousands and thousands of people dump a company plan and set up their own 7702 private plan. Interest is earned tax-deferred, and there is no market risk. Further, because of heavy regulation, the person representing the 7702 private plan administrator must present a detailed retirement illustration that discloses all costs and fees. In most states, they even have to show you what would happen if you put your money in and the market kept going down. all the way to zero. The 7702 private plan is new. It became IRS approved in 2005, but it is already gaining mainstream popularity. That is the best way to get back at all these greedy people. Pull your money out of a 401k, or at least stop putting money into it, and start your own 7702 private plan.
Does it have a link to his company website at the bottom?
It doesn't.
Interestingly enough,
there might have been one there originally, but they might have removed it through moderation.
Because he's now in jail.
After you read that, you kind of want to go take a shower.
Yeah. I mean, in case, can I just go ahead and say this? In case anyone's wondering and we haven't been really, really clear, there is no such thing as a 7702 private plan.
Right. Thanks for bringing that up, because that's a point that I often reference. So the pushback that we get from people who want to pitch this idea as a 7702 plan often say, well, there is no such thing as a 401k plan. And what they mean by that is 401k is a colloquialism. There's no such thing officially as a 401k plan. The plan is simply a trust that is established, and we refer to it as a 401k by referencing the IRC code again that speaks to the law that makes 401k plans what they are and gives them the benefits that they have. Here's the unique difference. Brantley, you've probably been asked, as have I, the question from people who have no idea what they're doing or what they're talking about, consumers, I mean, not agents, who will come to you and say, hey, is an IRA a good investment plan?
Yeah, absolutely.
And you stop and you go, okay, the IRA is not the investment, it's the account. Same thing with the 401k. It's not the investment, it's the account.
It's just the shell. That's all
right.
It is.
It's the trust that gets set up, and whatever you put in it that's allowed to be in it receives the benefits that the account creates. There is no 7702 plan. There is no trust established. Trust me, we don't want there to be. The benefits that you reap from this are simply inherent of the product itself, which is life insurance.
That's it, and that's all the 7702 can be.
Mm-hmm.
It is life insurance. I mean, it's not. I mean, that's the other thing that's sort of intellectually dishonest about it. Is that, you know, a 401k, since it is a trust, and certainly there are guidelines as to what assets can be held inside of a 401k plan. It can be more than just mutual funds, for example. And it can be different types of mutual funds within that. And it can be stocks, and it can be bonds, and it can be all of these various things. A 7702 plan will never be anything but life insurance.
Right.
So, you know, for proponents of 7702 plan to attack the 401k plan. And can I make a side note here and say that we're not in any way, shape, form, or fashion big fans of 401k plans either. You know, I don't want our audience to think that we're somehow saying, yes, you should never, that, you know, the guys from the Financial Procast really love 401k plans. That's not going to happen.
Mm-hmm.
Because that has its own issues, which we're not going to get into today. But
to hammer the point, we don't go around pitching mutual funds to people, telling them that it's a Section 80A plan.
Exactly. And here's the big issue I think we have to address with regards to 7702 and 401k plans is that many people who are trying to pitch consumers on 7702 plans or 7702 private plans, we keep interchanging those because it's the same thing, will suggest that they should stop all their contributions to their 401k plan and withdraw all their money, pay the taxes that are and penalties that are due now, and dump it all into a 7702 private plan. And we have a problem with that.
We do?
Well,
no, I'm kidding. Yes. Well, first off,
as blanket,
the biggest
as a blanket,
problem,
I'm not saying that there can't be some situations where that certainly could be appropriate, but you know, to put it out there on a website or in a publication and say, this is what you should always do.
Yes, it's blanket advice.
It's crazy.
I mean, at the same time, we should point out that, well, I should just state that you can't withdraw money from a 401k plan if you're still employed, unless you've reached retirement age or qualify under certain other circumstances, or take a policy loan, or not a plan loan, which would be an utter
or you don't work
mistake.
at that company anymore.
Yes, but
I mean,
I said, if you're still employed, it's not going to happen.
Right. But they use the same advice for IRAs, for 401. You know what I'm saying? I mean,
yes, and so a lot of them, back during the Roth conversion hoorah days, there were a lot of people pitching 7702 as the way to still Roth convert. Problem being that you can't get that much money into a life contract all at once, without creating a modified endowment contract, unless you were going to sell them an annuity, at which point in time you could just roll it into an IRA. But there were people that were preaching 7702 plans vis-a-vis the Roth conversion, but still not being upfront about the fact that it was simply a move to life insurance.
Yeah, exactly.
And that's the big problem. It's not that it's a separate plan. And it's not, it's not that the idea doesn't have validity behind it, using cash value life insurance as an asset. It just means that if somebody comes to you and says, you should look at a 7702 private plan, you should turn around and run.
Yeah.
Because if they're going to start by lying to you that way, there's probably no limit to what they're going to lie about next.
They'll lie about other things too, right? Yep. That is the problem.
Now here's the other fascinating piece here for me. And this is just a testament of my utter geekiness when it comes to the industry. The National Association of Insurance Commissioners has created model regulation that has been adopted by 49 states in the United States to guide the way in which the sale of cash value life insurance needs to take place. And so it requires that sales illustrations are presented, and it requires that every sale be explicit in explaining that the person is purchasing life insurance. And I go back to that comment that I just read, where this person said that under regulation they are required to give you a detailed retirement illustration, which obviously is a reference to the sales illustration for a life insurance contract. And going back to that example that we brought up earlier from Northwestern Mutual, where it's not very clear by looking at it that this is a life insurance sale. Mm-hmm. That, to me, based on my somewhat crude and certainly not legal professional opinion, is a direct violation of that regulation.
Exactly. No, I mean, it is. It's clear.
In other words, as somebody who's licensed to sell insurance, I would be absolutely scared to pitch this to anybody in that regard, knowing that there could be significant ramifications to me personally by virtue of doing it.
Absolutely.
So I guess we have to ask, do we think that it's intentional mischievousness or just incredible ignorance?
On the part of agents, you mean?
Yes.
Both.
I mean, we've talked about the people who will present really bad products to people only to make a buck, and when you look at it and you go, what were they thinking? The answer typically is, well, I retire in 5 years, so who cares?
Right. I was really looking at that new boat.
Mm-hmm.
Yeah. I don't know. I think it's both. I mean, I don't think that every person, I know from our experience in working with a lot of agents and seeing the things that agents present to consumers, that a majority of the agents are not intentionally trying to mislead people or, perform some sleight of hand. they've been really, really, really poorly trained, and I think many times they don't even realize they're ignorant. I mean, you asked me which one. I think most are just ignorant to the fact that they're doing something they probably shouldn't be doing. Because our industry as a whole has a problem of training people to be really good salespeople, and giving them very little training on the inner workings of what it is they're actually selling.
Mm-hmm.
So I would say ignorance more than outright mischievous deceptiveness, but
And that actually is a very good point, because the other problem here is that lots of times people get this idea. They don't understand how cash value life insurance can work as an asset and as a savings plan. They've got designed completely wrong, but they
right.
go out and they pitch this idea as a means to sell life insurance. And it really, it gets very, very warped. In fact, we've already mentioned that there are posts that I have put out there that speak specifically to the 7702 private plan, and we discovered that somebody actually referenced a piece that I did on 7702 plans on Reddit when somebody came there saying that they had been talked into a plan and were wondering if it was a good idea. And this particular situation, and this happened like a month ago. This particular situation was a guy who was like 19 years old. He worked for Starbucks as a barista. That's not exactly a highly paid profession. And some jerk agent talked him into, like, I don't even remember the amount. It wasn't a lot, like $50 a month.
Yeah, it was ridiculously small amount of premium.
Yeah. To be putting into a 7702 private plan. And when we found out that we had been linked there, I actually went there and offered to, assist the guy if at all possible, and help him sort of figure out what happened and how he could get out of it. We never got any details. There was no follow-up on his behalf, but based on what we both know about these products, it's very hard to design these things to work in that fashion when that's the limited amount of premium going in.
Yeah, absolutely. Yeah, it's there's just no way. I mean, the sale was completely inappropriate for the Starbucks barista.
Mm-hmm.
I mean, there's nothing wrong with being a barista at Starbucks when you're 19 years old.
Right.
But to pitch him, and there's nothing wrong with him buying life insurance for that matter.
Right. And there's nothing. I'm not trying to be an elitist here. It's not like
No.
you have to be at a certain level before you can do this. That's not true. You just have to have a certain degree of money going in order for this to work.
Yeah, for it to really be effective.
It's not as much as we're probably making it sound, but $50 a month is not yet. It's not completely off base, but it's not yet there.
Right. It's just not going to be hugely impactful for this guy.
Mm-hmm.
Not the way that it should be. So, yeah, I mean, these are this kind of situations that make you sick to your stomach a bit, right?
Mm-hmm.
And I mean, we sort of hinted at it just
because that guy
ago.
could be a barista at Starbucks studying while he's going to college, and will one day be a CEO of a Fortune 500 company, or he'll end up being a cardiologist who does invasive surgeries, and he'll have a substantial income. And at that point in time, it'll make sense for him to look at this. But if he gets burned at 19 because some jerk agent gypped him $50 a month on a bad idea, then he's going to be emotionally opposed to that for probably ever, not understanding all of the bigger picture.
Yeah, and he's going to tell all of his friends, anytime anyone brings up the idea of using cash value life insurance, he's going to give them the 52 reasons why they shouldn't do it.
Mm-hmm. Because it didn't work.
Because
it didn't work in
for
this
him.
one situation where it never works.
Right, where it was set up to fail from the beginning.
Mm-hmm.
Hey, that's another thing I had that I wanted to touch on was because we see this happen all the time in this world. that people go out and pitch the use of cash value life insurance. They pitch a 7702 plan, and then they set the policy up all wrong.
Yeah.
So can you talk a little bit about that?
That sounds like another show, but
Yeah, I mean it could be. I mean, it could definitely be a separate broadcast, but just, I mean, we don't have to go on about it for half an hour, but just, touch on that a bit.
so when it comes to cash value life insurance as a savings plan or an asset or however you want to define it and look at it, there are very specific ways that design has to take place in order to maximize benefit to you, the client. And a lot of agents either don't know or choose not to. They say there's two reasons you don't do something in life. Either you don't know or you don't care. And so the design, very, very quickly, and I'm not trying to be exhaustive at all about this, is whole life insurance needs to be blended and funded with more PUAs. We're probably looking for a 50-50 or more in favor of PUAs blend of your total outlay, PUAs to base whole life premium. And on the UL side, we want to make sure that whatever the outlay is the guideline premium for the respective death benefit. That will ensure mitigated expenses from the policy to give you the best bang for the buck in terms of what's going in every month, quarter, year, whatever.
Right. And that's a good enough explanation to me for this episode. But the point that I was trying to make was that we oftentimes see agents not doing this. So the consumer thinks they have one thing and they don't.
Right. We put a little tiny PUA rider on it, paid up additions rider on it, so that maybe you can add more later if you want to, but I'm not worried about that.
Right. When your income goes up, you can put some more money in this policy.
What if it goes down?
Right. Well, it won't matter because I will have gotten paid all I was going to get paid at that point. So. I mean, that's basically.
I got the maximum benefit out of you that was possible. So if it goes down, whatever.
Exactly, and that's the thing. I mean, and this is blatant. I mean, this is just blatant commission grubbing, I guess you could say, in that agents who sell policies in that way are selling them to maximize their commission.
Mm-hmm.
And and I think there's a certain degree of ignorance there as well. But it was
in case everybody's wondering.
Go ahead.
In case everybody's wondering, no, we don't have any friends.
No, in the industry, yeah, no one that will openly admit that they're friends with us anyway. No, my point is just that this is something that's done within the industry. And you might find a new agent who really is ignorant of the fact that he's not doing it the right way.
Yeah.
But that's because he was deliberately trained to do it the wrong way.
Right.
To maximize someone's compensation down the line.
I have run into situations where policies were sold under kind of a team circumstance. You've got the new agent and the senior mentor agent. And the new agent is like, well, wait a minute, shouldn't we do this because it benefits the client better? And the senior agent's like, shut up, you want to get paid? And clients see through it lots of times. And it's just sad that oftentimes plays out that way.
Right. Well, oftentimes they find the Insurance Pro blog and they come over and start reading and go, wait a minute. I don't think this guy's doing exactly what he's supposed to.
That's not what mine looks like.
How come mine doesn't look that way? Shameless plug there. But hey, the last thing that I had on my list, and you may have some things on yours, but that I wanted you to talk a bit about, and I don't think it's happening as much as it was at one time. Although there are a couple of websites that are very prominent when you Google 7702, besides ours, another shameless plug, that talk about equity harvesting to fund your 7702 private plan. Like I said, I'm not sure that it's happening as much as it once was. I know it's not. As a matter of fact, that's a definitive. But talk a bit about that strategy and what's wrong with that.
Equity harvesting. So, like, where do you buy equity seeds?
At the mortgage lender's office.
Oh. Yeah, so
And they're really, really expensive.
they cost points.
Yeah.
So there has been a very long-standing practice within the insurance industry to coordinate with other financial arms to use different sorts of financial tools to extract more available money to put into a life insurance policy. The biggest example, which has really died down a lot in recent years, has been home equity. And you'll see a lot of people pitch this not just in 7702 plans, but you'll see it in Bank on Yourself, a registered trademark. And you'll see it on the Life Economic Acceleration Process, LEAP. Circles of Wealth has a certain aspect of this. And basically what it involves is tapping these other sources like home equity to get a big loan to stuff it into life insurance.
I thought we were just helping find the money, Brandon, to make their plan possible.
I'm helping you. Let me help you help
me. That's exactly what I was going to say.
And I'm not saying that it's always going to be a bad idea. I'm just saying that there's not going to be a ton of situations where it's going to be a good idea.
Right.
In other words, we're not trying to be closed-minded here. We don't want to categorically say never, ever, 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 ever. We just want to say probably not likely.
Sure. And just and be upfront about what it is that you're doing from the beginning. I mean, if I was going to, and I'll just speak personally, if I was going to recommend that we look at that as an option for a client, I would say something like this. Sometimes we can reposition, money in a way to I would frame it something like that, to make a better use of it. And if I was going to suggest looking at home equity, I would say, if you're comfortable with the idea, we could look at repositioning your home equity into, any. And I think, for me, that's such a rare idea, and you and I have talked about that. I'm not comfortable with recommending that people pull money from their home equity to invest into cash value life insurance, or really to. I'm not saying there's not a situation where it wouldn't work, but it's not an idea that I'm very comfortable with on the surface.
Mm-hmm. Outside of home equity, there are certain circumstances where you can get loans to fund life insurance. That's
Sure.
how premium financing works. And mathematically, it is a very sound recommendation. But you need to have some substantial assets before anybody will even look at you for that.
And there's a very unique set of circumstances where it makes sense.
Mm-hmm.
It's not a and that's not. I don't want to chase a rabbit too far, but these websites that are geared to teach people how to take equity out of their home to put into a 7702 private plan are. I looked through pages and pages and pages. There's no mention of life insurance anywhere.
Mm-hmm.
Anywhere. It is a secret 7702. It's a little known secret that no one wants you to know about.
Right.
That's how they phrase it, because that's headline, that's marketing, that's direct response copy.
That's why they put the word private in there to begin with. It's the 7702 private plan.
Right. Yeah, it's so private. We don't want you to tell anyone else what you
so
did.
Private. We're not sure how you found us.
Exactly. It's just a marketing tactic. But to me, the equity harvesting bit is we'll talk about a financially a risky strategy to me that that really borders on. Um,
You're right, because at that point now you're giving them an obligation that says you've got to pay back an equity loan. And worst case scenario, you fall into a financial rough spot where you can't, and you put living in your house in jeopardy. Um, Now, theoretically,
I'm just not a big fan of mixing where I live with my investments.
right,
I mean,
you don't look at owning a home as an investment to build wealth in.
absolutely not. I look at it as a safe place where my family is able to take shelter and
Hmm.
share good times. And I mean, it's a great thing to own a home. There's nothing wrong with that at all. But I've never viewed my home as an investment.
Now, the pushback from those people is going to be, yeah, but if you take out the equity and you put it into the 7702 private plan, and all of a sudden you can't repay the loan, you can just cash out the 7702 plan and pay back the loan. And to a certain degree, I'll say that if designed properly, that's probably correct. But you
At
and I
some
both
time in the
know,
future. At some time in the future.
right? You and I both know that most of the time, this is a sale purely for the purpose of gaining premium and selling life insurance and making money for the agent. And so it will take a very long time for that person to actually have the cash on hand to pay off the loan.
Right.
And so they do, for the first several years, run the risk of not being able to satisfy the loan.
Absolutely. Yeah, I mean, there's no predictability as to how it will work out exactly. I
Now,
mean,
one thing I do want to point out, though, is, um, and you may want to push back on me a little bit about this, because based on other conversations, I'm not so sure we're on the same page. But I don't see too much of a problem with somebody who's looking to save more money, who currently could reposition debts through something like a refinance or an equity loan, and does that and uses that saved outlay every month to then fund or to place money into a cash value life insurance plan. And I say that because you and I have both discussed the fact that people who get themselves into large amounts of debts tend to get themselves into larger amounts of debts when they reposition and consolidate loans. However, if we reposition and consolidate and then take their outlay and stuff it into stuff is really not the right word, and commit them to life insurance as a savings plan, then they don't typically have the outlay to go out and spend it on other things. We've got to do something about getting rid of their access to debt and lending, but we can probably do that. And so they typically end up better off.
right.
And I don't want to dive into some new plan. I just want to point out that in the world of using refinancing as a way to start saving more, we're not taking that off the table. We're just saying
No,
don't go out and get
definitely
an
not.
equity loan and pile the loan into life insurance.
No, exactly. And I'm not, I don't want anyone to think that intellectually, I agree with you 100%. My problem with debt consolidation can be not, and it's not always the case because everyone's in different circumstances. I don't want people to do it if I feel like they have a behavioral problem with their money. If they're financially immature and I feel like they're just going to go out and do it all over again because they still have, let's say that someone has $40,000-$50,000 worth of credit card debt and they're able to roll that into a refinance. They have enough equity in their house, and they can keep their what am I trying to say? Their equity position, even with the refinance, under 80% of the total value of the home. I don't necessarily have a problem with them doing that unless I feel like they're going to go out and charge their credit cards back up as well. So now they have a smaller equity position in their house, and they've also charged back up all the consumer debt that we consolidated. So now they're in a much tighter place financially. Now, if they were also, stuffing, quote unquote, to use your terminology, the money into the life insurance while they were doing that, they're certainly going to have some accumulation there that we could use. But if we end up having to pull the money out of there to bail them out of trouble, then that sort of defeats the whole purpose of them starting the plan in the first place, right? That's my problem with it. But it's not that I don't think it's and mathematically a lot of times it is a great thing to do, right? My problem in personal finance typically is that the math and emotion don't converge always. So that's just my little sidebar, I guess.
And now that we've beat this topic sufficiently to death, it's probably time to call it a day.
Yeah, I think we've done our due diligence at bludgeoning the 7702 private plan.
As it should be. As it should be.
As it should die a long, painful, and slow death, much like this podcast episode.
All right. Well, on that note, I'm Brandon Roberts.
And I'm Brantley Whitley.
And next week we'll be back to the regular. See you then.